and then I'll share it in the other room too. Lorna, should I record from this room? Yeah, okay. So let me do that. All right, so let me see. You guys should be able to hear in both the small out room and mastering the trade room, I think. Perfect. All right, excellent. Oh, here, let me share this with Rinda real quick. Um, okay, there we go. Da, 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 da. There. Okay, perfect. So a couple things we're going to go through on this, and I like to kind of do this like once a quarter ish. What we want to do is we want to go over just kind of the bigger picture forces that are driving essentially the world, because then we will better understand how asset prices will react to that. And then we'll kind of dial in. We'll also talk about the 18.5 year real estate cycle, which I think is going to be pushed out a little bit, not by much. And then also just kind of some important shorter term cycle dates that are coming up. All right, so that's all we're going to look at there. And let me just grab my Camtasia drawing tool. All right, looks like that is going perfect. And there we and action. Okay, perfect. All right, so this is all the stuff that kind of I like this stuff too, because it's all the stuff that kind of runs the world, and so we want to just be aware of what's going on there, right? So I think which makes sense. So here's I think, bigger picture. We just want to understand that the mega trend of growing global debt will continue. Okay, and there is no government on planet Earth that is incentivized to cut spending. Even with the latest election, we saw that there was going to be a lot of cuts and Doge and all that kind of stuff too. And what happened? We ended up getting a bill passed that's going to increase debt by $5 trillion. Okay, there's a whole reasoning behind that. So here's the thing: governments aren't in the game of running sound economic policy. They're in the game of winning votes. And I think one of the biggest misunderstandings of many people in the population, especially if they spend most of their lives on social media, is that they kind of think that government is here to take care of us, and they're not. That's absolutely not what they're here for. They're here to win votes and kind of push their agendas forward and create a tax base. And I think it's always important to kind of understand that. And if you've ever seen like a big company, whatever the company is, Boeing, IBM, everybody's messed up, right? And then if you see all the, the memos that they release or their PR tries to, make it look better than it is. I would argue that probably people in business as a whole, um, to the extent that they do that, politicians do that 10 times more and try to always reframe the message and make it look good. So anyway, just we got to understand, I think it's important for your own well-being to understand that, the government isn't here to save you and take care of you, right? They're here to get votes and make sure that their debt can be maintained and that taxes are paid. And that's basically it. So, and it helps with this because um, the reason it's important to understand this is because this is going to be the basis of all economic policy. And if we understand economic policy, we can then benefit from investing in the things that will help. Okay. So essentially, tax cuts and healthcare benefits provide financial incentives for votes. Bottom line, and this is the absolute end game, is that currency debasement. And it was essentially means that, $100,000 today buys you a lot less than it did 3 years ago, which buys you a lot less than it did 10 years ago. And in fact, currency debasement is actually planned at 8% a year. You add that on top of inflation of about 3% a year. And that means that if you have a pile of cash sitting on your desk, it loses 11% of purchasing power year after year after year after year. And you've gotta at least, at the very least, structure your life so that's offset. But in a perfect world, you actually have assets that offset that by quite a bit and then some. So, if you have if you have assets that return 10% a year, you're losing 1% a year. So think of it that way. Yeah, and that's absolutely why Bitcoin, and we're certainly going to be talking about Bitcoin and a couple of other assets and things like that too. So currency debasement runs at 8% annualized on top of inflation at 3% annualized. Okay. And we're just kind of talking about that. So that means every year cash is losing 11% in purchasing power. And the only way to offset this is by holding assets that offset, or ideally more than offset, this reality. Um, this is why Bitcoin is certainly gained in popularity, but essentially the two assets that offset this the most. So if you think of it this way, gold essentially kind of tracks it. Gold doesn't beat this, over time. It just kind of tracks this. Real estate doesn't beat this over time. It just kind of tracks this. Essentially, the two main areas, and to an extent, the S&P 500 sort of beats this by a little bit, but the two areas that beat this by the most are Bitcoin slash crypto, and then tech stocks. And we'll get to why here in a minute. Now, Elon thought he could do it differently, and in fact, he's gotten to the point where he's so frustrated that he wants to start a new political party. And I and look, I'm a student of history and of economics, and I'm a fan of Elon, but it's going to fail. It's just not going to work. You cannot shrink systemic liquidity without an economic collapse. And think plunging asset prices and a mass triggering of debt defaults. And at the end of the day, no one's going to vote for that. People are voting for tax cuts. They're going to vote for healthcare extensions and benefits. They ain't going to vote for a shrink in systemic liquidity, which he rightly wants to do. I'm not saying what his idea is wrong. It's never going to happen. Are debasement and inflation fundamentally different? Yes, it's a great question. Think of they work together, but they are two separate things. So let's say currency debasement runs at 8% annualized, and let's say on top of that, if we're in Argentina, where inflation, I don't know what it is right now, but let's say it's 60% annualized. Well, now your purchasing power is dropping by 68% a year, right? So it's even worse. I've got a friend that runs kind of a group of about 100 programmers out of Brazil. They do not want to be paid in, I think it's the real. That's their currency. They typically get paid in crypto and like Tether and things like that. They absolutely do not want to touch their fiat currency, which is getting destroyed by inflation. So so right now in the U.S., it's about 3% annualized. It could be higher, but they're two different things, but they're both They're both doing the same thing. The currency debasement is based on an increase in money supply, which we will get to as well. So the only way to offset this is by holding assets that offset, or ideally more than offset, this reality. Okay, so that's the bottom line. So the other thing, and it's admirable that Elon and other people want to lower debt. The reality of it is it's never, ever, ever going to happen. It's never going to get paid off ever, and it's it's just important to get our arms wrapped around that. The only answer, the only answer that's feasible in this day and age, and it's not just for the U.S., it's for Europe, it's for China, it's for everyone, is to focus not on lowering debt, but to lower the ratio of debt to GDP. Okay. So, debt as a percentage of GDP is something that's manageable. And simply that means as debt increases, what else has to happen? GDP has to increase. And ideally, GDP has to increase even more. Okay. So, what happens if GDP doesn't increase? Well, bad things. So, let's talk about how that's going to happen. So this happened in the 1950s and 1960s. We had a baby boom and rising productivity. And what happened is, even though debt expanded as a percentage of GDP, it wasn't a big deal, and everybody lived happily ever after. For us, currently, there is absolutely no baby boom on the horizon. People are not wanting to have 12 kids, and they're having 0 to 1 or 2. So where is GDP expansion going to happen? Well, you've probably heard of this thing called AI and also robotics. Over the next, I mean, probably way less than 10 years, but AI and robotics are going to absolutely get into a point where you have GDP rapid expansion. And then from there, 20, 30 years down the line, what's going to be the next thing? We don't know at this point, but AI and robotics are both growing in a furious and substantial way and are poised to have a huge impact. So this game that we're playing is, it's going to continue throughout at least our lifetimes, and there really is no final outcome. There is no utopia that we're heading towards. It's just, this is it. This is the game that's been set up. Humans and their politics and their economy are always going to be messy, just as they always have been messy. Okay. And that's not going to change anytime soon. And the idea that it is going to lead to a lot of frustration. Essentially, for anyone that bases their life on, no, we got to fight and we got to get, we have to reduce debt and get the budget balanced. Yeah, it's not going to happen. So then the question is which societies will embrace technology and which will shun it? And that's really going to drive the next wave of economics here. China is furthest along in terms of embracing technology, with Europe generally pushing against it. And then you've got the US kind of in the middle of both. If you guys have heard of the fourth turning, political harmony is impossible at the fourth turning. There's just too much change too fast as one system dies and another is born. But everyone is in the same debt boat. And by everyone, I mean all the developed nations of the world, and will have to continue to debase their currency to pay for their aging populations and support this transition. So this is essentially, why this understanding of debasement of fiat currency is so important, because it's the only viable alternative to getting through all this. So all the governments know the game. It's to debase their currency gradually. Okay, if they can't do it too fast, because then that throws a lot of things out of whack. They all know that the economic engine is only about debt servicing. Okay, the reason GDP is so important, the reason pro-business strategies are so important, is because the economy today is essentially here to service the massive amount of debts that have been created, and that's going to become even more so as time goes on. This will be the underlying basis of all politics. All the politics you hear is noise. Underneath it all, it is all about essentially servicing the economic engine so that debts can continue to be serviced, and that's just it. And so the big beautiful bill that recently passed, that adds $5 trillion in debt, even though there is a lot of talk of cutting costs and things like that too. So that debt's been added. So how are you going to fund it? By adding The SLR, this is a supplementary leverage ratio. This was just included in the bill. This is exactly what happened during COVID. I think it was in May of 2020 when they said, okay, banks, um, your regulations are going to be loosened up a little bit. Your leverage ratio is going to be given more room so you can absorb more of the debt. Okay. Well, guess what? So there's going to be $5 trillion in new debt issued. If they just throw it on the market, that's going to drive bonds down. And that's going to do what? Drive interest rates up. Well, now all of a sudden, banks are going to have a lot more flexibility in absorbing this debt. Okay. So think of this as a stimulus boost in liquidity, and then you start seeing the liquidity now, you start seeing the impact of it in Q4 this year, likely into the middle of 2026. Okay, what about stable coins? There's been a lot of talk about stable coins, and guess what? Stable coins were also included in the big beautiful bill. This will boost US dollar dominance and start to erode the euro dollar system. Okay, why is this important? The euro dollar system allows foreign banks to get direct access to dollars via the Fed and lend them out to the rest of the world. So essentially, Europe, Japan, they could go to the Fed, get direct dollars directly and loan them out there. And that kind of helped create a world that saw dollar dominance. Dollars, dominates so many things out there. 60% of all debt is in dollars. 65% of all trade is in dollars, especially when you're counting oil and things like that too. And it just, the idea, dollars are just dominating everything. What do stable coins do? Stable coins, a lot of, there have been talk, oh my God, stable coins, it's going to, the dollar is going to go under. No, no, no. It increases dollar dominance and removes the power from capital constrained foreign banks. Okay, this is a big deal. In the euro dollar system, you have banks from Europe and banks from Japan. They're loaning, getting money from the Fed. They're getting dollars and loaning it out, but they're limited to what they can do because they've also got capital constraints and things like that too. Well, so now we're just going to kind of, they can still do that, but now we're going to actually go around them, and we're going to put it right in the hands of non-fractional reserve stablecoin issuers who will match their liabilities to US Treasuries. This allows for limitless expansion of dollars into the global system, and not only to the banks, but to corporations and individuals. Basically, anyone with an internet connection can save and transact in US dollars. So, Scott Bessent, have you seen him in the news a lot lately? He believes that this will see, by essentially supporting the stablecoin community, and that was also included in the big beautiful bill, that will create $3 trillion of demand from stablecoin issuers in the next few years to absorb a good majority of that $5 trillion in newly created debt. Guess where the other $2 trillion gets absorbed? By loosening of the bank regulations. So they've already teed up, the idea here, they don't actually need to cut a bunch of taxes to do this. They just need to make sure that when they bring this debt to market, there's somebody there to absorb it. And now they've already got essentially that teed up by loosening the regulations on banks and essentially getting rid of a lot of the regulations to encourage the use of stablecoins. So Besant is basically creating a new market for U.S. Treasuries above and beyond sovereign wealth funds and banks and all that kind of fun stuff. He is creating a situation where he's able to sell bonds to individuals. In corporate talk, this is called increasing your TAM. TAM stands for total available market or total addressable market, depending on who you're talking to for your product. In this case, U.S. bonds. So essentially, Besant went out and said, you know what? We got to increase the total addressable market for our product, which is US debt. How are we going to do that? Okay, let's loosen up the regs on banks and let's unleash stable coins onto the world, and bada boom, bada bing. So a lot of things that are kind of happening in that bill are very, very, they're not going to help our debt, but what they are going to help is an increase in money supply and a loosening of essentially quantitative easing, which does what? Which increases asset prices. Yeah, but how does that help TLT get to 90? Yes, TLT gets to 90 with some longer term options, is basically how that happens. So the big bill is going to increase debt by 5 trillion. Besant is creating a market to fund that debt by loosening bank restrictions and unleashing stable coins. So now all that's remaining is for the Fed to start lowering rates. to drive growth in middle America and to allow the Fed to roll their debts at lower cost. Now, I don't know if Powell is going to start doing any rate cutting anytime soon, but certainly when his term comes up, I think it's Q2 of next year, he will be replaced with a much more dovish, someone with a much more dovish outlook because they obviously can act independently. So what about business? Is the economy strong? Or, yeah, still probable for September. Is the economy strong or is it falling apart? Well, it's slowly increasing. The ISM came in at 49, which is slightly higher than expected. Note Bitcoin and the alts typically have their biggest moves when the ISM crosses 50. Though it's actually spent the longest time below 50 ever recorded. Okay, so why is that? That's driven by a US dollar that has been too strong for too long, which has recently fallen sharply, and interest rates staying too high for too long as well. The falling US dollar will help drive the ISM higher. Okay, the falling US dollar is essentially the same as loosening up global financial conditions. Global manufacturing PMI is rising, with 9 industries reporting strong growth at the last reporting. So at the end of the day, now I've seen some doom and gloom. Oh my God, the dollar is falling. It's bad. No, it's not. Nobody on planet Earth wants a strong dollar. The Plaza Accord, which was you may have heard of, which was done in the mid 1980s, this was essentially the largest economic powers coming together for the specific purpose of bringing down the U.S. dollar, which they did by 40%. A high dollar constrains global growth at the end of the day. That's it. So the same thing happened in 2017. In 2017, the US dollar was too high. There was a coordinated effort to bring it down. Trump started his presidency with the dollar is too strong, and it has since fallen sharply from, I believe, I think I've got a chart on it from like 110 to 98. Very likely, what will come out is this is going to be something that was also coordinated with Japan and China and Europe and everybody to say, like, look, nobody wants a strong dollar. How do we get this? How do we get this done? Well, that can only be done by a facilitated effort and coordination. FX, especially with the euro and especially with the yen. It only happens with a coordinated effort because that's too big of a move. So if we look at this about the time Trump was elected president or essentially came into power, we've had a rapid decline in the dollar. And this was at the top of his list that he's like, all right, guys, we need to bring this down. So Trump wants a weaker dollar, but you know what? So does Basent, so does China, so does Europe, so does Japan, and I don't think there's anything been reported about it, but they certainly all are. They certainly all are working on this together because the lower dollar benefits everyone involved. It benefits the U.S. It does benefit China. It does benefit Europe. It does benefit Japan. A couple ways to think about it, of course, for the US, the lower dollar makes exports more intriguing, so it can increase our exports. Um, I think something like 65% of global debt is issued in dollars. So if you're an emerging economy and the dollar's at 110, that means you need, if you're in South Africa, okay, you need X amount of rand if the dollar's at 110 to pay off that US based debt. If the dollar falls to 98, now you need less rand to convert to dollars to pay off that same debt. So what that does is it frees up a lot of capital in the system. Essentially, it's a way to increase liquidity. So the more the USD drops today, so here's the big part of this, and this is where we're going to also kind of bring in. We're talking about the 18.5-year real estate cycle, which essentially is kind of teed up for 2026. I do think it'll be pushed out by a year or so, or because part of the question is like, is it already happening? Because the real estate market is coming. It's been coming down. It has been coming down. Certainly there's no. I wouldn't say there's any. Well, maybe so. I mean, I know there's areas of places like condos in Florida and stuff like that are pretty bad. Um, but the economy in 2008 was also going in the shitter, whereas that's not what's happening here. So you got a little bit different situation, though I still expect the same thing to play out, just a little bit delayed. But essentially, with the dollar dropping now and the possibility of interest rates, getting more aggressive in interest rates, that would look to kick this out likely into 2027. Um, So the dollar weakness equals a loosening of global financial conditions, and this drives the economic cycle, ISM, higher. And that's something that we'll start to see as the ISM starts to come out. You'd expect higher and higher readings. And again, remember, once the ISM crosses 50, you typically see that strongly represented in Bitcoin and then the altcoins. So I would say right now, because I mean, Bitcoin made new highs today, but it's not really off to the races. I would say that Bitcoin and the alts have not taken this into consideration. So I think there's a lot of interesting plays here with the idea that this lowering of the dollar, okay, the opening up, the loosening of the bank regulations, and the opening up of stable coins to absorb debt, you're going to see a pretty good run in Bitcoin, Ethereum, and the alts into early 2026. So I think that's a pretty interesting one. That too. No, that's good to know. So yeah, and some of the stuff like in Florida, it's just stuff that I might read about. And of course, I think sometimes, if you're on Twitter or if there's a Reddit forum, there's a vested interest in doom and gloom, and so not necessarily all the reports are accurate. So yeah, that's a good point. There's still people moving into Texas. There's still people moving into Florida. All the fun things. Okay. So what about stagflation? So stagflation is essentially when you have high inflation or stagnant or declining economic growth. That's not what's happening. That is absolutely not what the world is experiencing. I've just seen a lot of reporting like, oh, we're going into stagflation. We're not. And essentially, with the crushing of the dollar, growth will be accelerated. And remember, both the NDX and Bitcoin essentially are 90% correlated to the global money supply. So here's the trend of the global money supply right now. That essentially points the NASDAQ up to about 26,000. Here's the trend of Bitcoin. So black is the money supply trend, and then red is the market. This implies Bitcoin, again, we're talking, mid 2026, 180 to 200,000. So that's kind of, they're 90% correlated to the money supply, and that's what the money supply is projected to do, and that's what you would see there. Now that doesn't mean that we're going to see the Nasdaq and Bitcoin rise every day, right? We're going to see flushes to the 21 EMA. We're going to see some, normal back and forth along the way. But if you're thinking in terms of, what I want to, do I just, again, just kind of the idea here that Robert Kiyosaki is right and that the markets are going to crash so hard and that you're going to lose everything is just so far off of planet Earth that, it's not worth listening to. This is how the world works, and we just want to understand it and not fight it too much. I even, even when the market is extended, I'll try to buy puts as a hedge, and the puts just don't, they just expire. It's like, oh, okay, I guess we don't need puts again. So we all know that the market can kind of, it's going to, have its pullbacks and things like that too. But we just don't want to underestimate um, the constant, incessant institutional bid that's in these markets. And it's like this because of everything that we've just talked about. Yeah. um, So basically, the economy is holding up. The massive pullback in the dollar will start to see positive economic impact in the months ahead. And global liquidity is rising, which means asset prices follow. With the big bill, remember, banks will have more room now to lend more, rhymes with roar. And this is basically QE, and it can have a huge impact on liquidity. This is very similar to what happened during the pandemic after they loosened the reins. If you remember, of course, March, everybody was panicking. And then I think in May, they loosened the reins. And if you guys remember the real estate market, starting at like Q4 2020, it was insanity. Now, of course, a lot of that was because of the work from home mandate, but essentially getting a loan wasn't that hard, right? And it was, and a big part of this will be interest rates. And the last domino is interest rates. At some point, they will come down, whether it's Powell starts doing that in September or he retires and someone much more dovish gets into his place and gets more aggressive. So the goal is to have interest rates below nominal GDP growth. Um, currently, Currently, the government in charge is trying to spur growth with tax cuts and deregulation. Oh, you guys were trying to move to Florida at that time. Yeah. You know what was interesting is in Austin, Texas, we at the time we lived in Lakeway, and we were back and forth between Lakeway and Wimberley, and we decided like Lakeway, okay, we're let's move. We started looking for a house. This was in 2019. Started looking for a house in kind of off of Southwest Parkway, if you know the Barton Creek, Barton Hills area. Found one that we liked. It was a new build. Put a deposit down. My wife and I went to India with YPO, and we did this kind of 10-day crash course on the Bhagavad and made it back to America, the US, within 2 weeks of the lockdowns. So there were people that I knew that didn't make it out of India, and they spent essentially, the first 6 months of COVID there. That would have been tricky, leaving 3 kids at home. And that was a good time to do a crash course on the Bhagavad as well. But what was interesting is then, we just kind of, we put our deposit on the house. It was still being built. We're like, okay, we should sell the Lakeway home. Finally, at the end of 2020, we decided to sell the Lakeway home. We bought it for $450,000. We, um, we started looking at the housing prices. We're like, dear gosh. And so I think we put a list price on it of 925, thinking like, well, let's just see if anybody takes it. And we got 6 offers, over the asking price, which, a lot of people experience that. So that was obviously insanity there. And then currently that's now shifted back to a buyer's market where, everybody's trying to figure out like where that's going to do. But so the whole point of all this is that I don't think real estate prices are currently like this, like 2008. I think real estate market is more kind of like this, for now. And then we'll see it. And then at some point, we'll talk about the real estate cycle and things like that too. But I don't really see that happening um, in the very near future, simply because we are in the process of seeing fresh economic growth, the process of liquidity being added to the system, all the fun things. Powell's term ends 5/15/26. Yeah, yeah. So we'll see if he, yeah, see if my Sanskrit stuck. Um, so yeah, so that's what we'll look at there too. And then I love this. So that's the reality of the situation. And then you have clowns like this. Do not say I didn't warn anyone. This is June 3rd, 2025. As I predicted in my book, Rich Dad's Prophecy, the biggest crash in history is coming. I am afraid that crash this time is now and through this summer. Unfortunately, millions, especially my generation of boomers, will be wiped out when the stock and bond markets crash. So anyway, there's always going to be that, but that's not what's happening here. Okay, so that's the big picture. So now I want to talk a little bit about cycle highs. So the last cycle highs we talked about, this was back in, when was this? This was May 1st. So we did an update on May 1st and talked about the cycles of the white metals. So this is platinum. Platinum at the time was $1,083. April 2025 is a big cycle month in the white metals. Platinum, palladium, and silver. This kicks off with the potential for a huge rally into 2026. All right, what's happened since then? I think platinum is over $1,400 today. We can take a look. At the time, silver was $33, and today it's pushing over $39. So I always like to know what these cycles are doing, just because they just there's these weird things that kind of come into play, and I've just found that if I'm aware of them, it seems to make things a little easier. And and again, like anything, you kind of take it for what it's worth. Um, Vincent, if rates lower, taxes and regulations get cut, productivity explodes. We could see a real estate surge until about 2027. Yeah, I agree. I mean, I think we're actually, I think there's kind of another speculative surge, especially in land. So the main one I was looking at here is the stock market. And so I think this is an important one. So right now stocks are poised to rally into the end of July, and we are coming up on a recurring 8-month, i.e. 35-week cycle that pinpoints key turning points in the stock market. So when have these happened? There was one in late July 2023, late March of 2024, late November of 2024, and then late July of 2025. All right. Now, some of these were bigger pullbacks and some weren't. So, what does it look like? So, if we take a look at this, we can see this was late July 2023. This was actually a multi-month top. So, multi-month top, and then a decline, pretty decent decline from about 4,600 down to about 4,100 on the SPX. And then we rallied, and then I actually need to get there's also an 8-month cycle for bottoms. So then, you go flash forward 35 weeks, and here we are. And then that also put in a top. But this one, this is a weekly chart. So 1, 2, 3, 4, 5, 6. That was about a 6 weeks. So we went back to the 21 EMA. So that was a pretty, no, I would say normal pullback, whereas this one was a little bit longer. Fast forward another 35 weeks, and that was November of 2024. You got a little gasp of a rally there, and then you got a pullback to the 21 EMA, and then you kind of came back up. And then, of course, this was the trade wars and all that stuff, and a little crazy. All right, so when is the next 8 months/35 week cycle high coming into place? And that is at the end of July 2025. Okay. So I would just say that between now and the end of July, it makes sense to get aggressive on the long side. And then, as we get into August, just be a little careful. We can see what happened here in August. We can see what happened here in August, right? August, has been kind of a blah month. Doesn't mean that that's what's going to happen this time, but I think it's important. That's stuff that's just important to understand and to know. So for my personal plan on this is like, all right, well, I'll push it long in the and when I'm talking about this stuff, I'm talking about trading, right? Am I, long term? I've, VOO SPY. I don't sell it. You just add to it. So just keep in mind what I'm talking about is trading. So it's like, yeah, let's push the envelope here a little bit into the end of July, and then just be a little careful. And then, and then I want to see like, okay, what does David Starr analysis on Elliott Wave say? What are some other things, because it's the cycle stuff isn't the be all and end all, but when I find that I don't pay attention to it, it's usually to my chagrin. Is that the right word? My regret. And so I just want to keep in mind with that too. And it also keep in mind too, it may be as simple as, we get a pullback to the 21 EMA through August, and then we launch ourselves again. So just keep in mind that may all be all that happens as well. So that's what we got there. Oh, the how so yeah, so it's interesting. This place that we went to, it was in Pune, India, which is about a 4-hour drive from Mumbai, and we stayed there. And I had been to India 4 times before. My wife had never been. And but yeah, we went and we stayed at this place. So the place we went to, gosh, I think it's Vendetta World or something like that. But typically there's students there that are there for a 3-year program, a lot of college age and stuff like that. And not all of them. One was he was a trader. There was a guy that was trader married with kids from London, and he was there like for 3 years. I'm like, your wife and kids are home? He's like, yes. It's like, wow, okay. But what was great about it is that, yeah, you really, and this is the part that I think that I feel like sometimes I need to come back to, is that the thing that really stuck with me was just the whole concept that, attachment is a virus. Essentially, the human condition, the attachment is essentially a virus that destroys, lives. So attachment to what? Attachment to a particular outcome, attachment, all the things that attachment is, right? And I thought was some interesting concepts of essentially like desire. And it's like, let's say you have a goal to get something you want and then you get it. Well, then are you satisfied? Well, no, desire is like a fire. And the more you just keep throwing logs on it, it just keeps burning brighter and brighter and brighter. And so the whole idea is just to live consciously and not get sucked up into this, chasing, chasing the essentially the emotions of desire and things like that. Now, how do you balance that out with regular life? I mean, if I'm trading, do I have a desire to grow my account? Yes. Did I have a desire to like, oh, let's buy a ranch and add to it? Yes. And then, so it's balancing that out with like, okay, well, can we enjoy what we have, or do we need to go out and buy another one? So anyway, it was fascinating. I I'll find the book that it was based on. It was but it was great. I mean, it was really just kind of I'm really glad we did it, and it's probably time to review the notes. Um, yeah, exactly. No boats. I've never gotten a boat. Okay, so a couple of other cycles here. So what about bonds and TLT? Oh, TLT. All right. So for TLT and bonds right now, there's essentially quote unquote scheduled to rally into July 21st. I don't know if that's going to be enough to save our TLT. Um, Maybe worth kind of adding some lower strikes into it and see if that position can be salvaged. Gold, um, gold and silver also are poised right now to rally into July 21st through 25th. After which, essentially, for gold, a multi-month peak is likely. Doesn't mean it'll happen. Just again, according to the cycles. And then similar with silver, doesn't and silver may come back to like 30, 37 or so, and then continue higher later, right? But for now, between today's the 10th, right? The next 10, 11 trading days, look to buy the dip in gold and silver if you're looking for shorter term type of trades. So, oh, there we go. All right, so we got that. Okay, so now, so that was bulk of it. So I wanted to come back and revisit this bigger picture reminder. Now, we've been talking about cycles. This is one that I've been fascinated by. I've told this story before. This is the 18 and a half year real estate cycle. I was at the London Money Show in, I think, 2004, and I saw this guy giving a talk on this, and he was really smart guy. I thought it was interesting. I took it with a grain of salt, but we actually ended up sitting next to each other at dinner, and really enjoyed talking to him. And I got his book. And at the time in 2004, he's like, "Oh yes, yes, the next." He's Aussie, so that's not an Aussie accent, but mate, the next real estate cycle's coming up in 2008. You definitely want to be out of any real estate in 2006, and then you want to buy again in 2010. I was like, "Hey, yeah, right, buddy." Of course, we know how all that played out, right? And yeah, Philip Anderson, great guy. So now in his book, which is The Secret Life of Banking and Real Estate, it's very dense, but it's if you really want to understand how the world works, it's a great book. Even it's amazing just how much real estate and land prices and rent, essentially the idea of capturing rent um, from land derives the entire world. Um, so where are we in the cycle? So at action, so we're here, 2025, 2026 is essentially kind of, you know, essentially building up here for one last kind of speculative run. And this is really focused on land prices, by the way. So it's land prices that are the underlying measurement here. And looking for this run into 2026, 2027, and then you'd look for a subsequent decline into 2029 to 2031, which would be the equivalent of 2009, 2011, kind of what happened there. So so I still am looking for this to happen. I do think that because we've got the start of a business cycle that's happening, and this did happen. So the average is 18 and a half years, but there was one, I think it was after World War II, that extended to 20 years. And we're kind of in a similar situation because at the end of World War II, there was stimulus, all the things, and this got pushed out by another year and a half or two. I think that's what we're setting up for as well. And so let's then say, and look, 2029, you guys remember what happened 100 years ago in 1929? 100-year cycles are also a real thing. So I think, that would make sense as well. So, I think that, so what's the whole point of all this is it's just to be aware. And I do think that we're going to see stocks and crypto, especially rally. I don't think real estate's done. I don't think, we probably saw highs already, with the whole COVID scramble. Maybe not. Maybe things will get one more, maybe they'll get one more shot there. And remember, there's different factions of real estate. There's commercial real estate, which has been struggling, since COVID. Residential real estate, which has had a very strong run, and then essentially land prices. And really, it's the land prices that drive this. And when there's a speculative fervor of land, then it gets out, can get out of control. But what's happening right now is, banks are, they've been given permission to loosen their controls, right? So they'll be able to loan more. Interest rates, it's anytime mortgage rates get to 6.5% or so, refis start to jump up, and people are waiting for rates to come down to go out and buy a home. So especially, gosh, if we get mortgage rates under 6%, I think that will actually see a lot of buying activity. You've got as we were the home that we have in Austin, the mortgage rate on it, I think it's 2.9%. So it's like, oh geez, it doesn't make to sell it and find another one. But at some point you're like, well, we don't want to live in that part of town anymore. We want to, be closer to, in a different part of town. So, you gotta make the step. But I think there's this kind of anticipate this kind of essentially unlocking of a lot of hurry up and wait kind of moments, like that, if we can get rates down. And I think they will come down. I mean, they will come down because they have to come down. It's just a matter of when does that happen. Yeah, 2.75% locked in. I mean, it's just like, it's great. So I think that's the main. So these are older slides that I've used before. Um, we talked about different cycle highs previously and things like that too. So from here, I just want to show we've been doing a couple things. Do 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 do. Yeah. So most of you here are in our mastering the trade room. That's where we post a lot of these trades and things like that too. If you're not in our mastering the trade room, you can go to simplertrading.com/mastering the trade. And then also we do have kind of a mastering the trade university happening at the moment. And I'll see if I can find that. If not, I'll just post the links. But the university is essentially a group of classes that we're going to be doing. The nice thing, I know, so if you're in the mastering the trade room, obviously, I think you already have all this stuff. But what's nice about the room schedule, this is where a group of us, different traders, would come on. We'll talk about trades. I'll do shorter term trades as well as in conjunction with some of the bigger cycles that we've talked about, and so which is a lot of fun. And there's an app that sends out trades directly to your mobile phone, which is awesome. Uh, During the day, we're all sharing our charts just like I am now, and then posting alerts in terms of what we're doing and uh, different things like that as well. And that's what we got there. And then you'll see, yeah. And thanks, Lorna. And then also the MTT University. This is something, especially if you're newer or just kind of want to dive in. The MTT University is, someone keeps asking like, hey, the last edition of Mastering the Trade was like in 2019. Are you going to update it? I'm like, that's a lot of work. That's a big book. That's probably where it's going to end up. And if I ever do another one, it might be new. But this is a way to go through all the chapters and just update them. So we've already done one on Mastering the Trade psychology. We just did one last month for the Squeeze Pro entries. Henry just did one, scalper alerts for intraday wins with zero DTE. So that was pretty awesome. And then we've got some more coming up as well. And I think you can get these a la carte or all together. So just kind of a way to stay in touch with stuff. And then for these big picture outlooks, I've been doing them. Typically I like to do a big picture outlook at least once a quarter. Because from a month to month, it's not going to change that much. But it's like, all right, where are the global supply levels? What are some of the big changes that have come up in policy that are going to impact asset prices? Are we seeing a tightening of liquidity or a loosening of liquidity? And because those are all super important things that drive the markets, and we just want to know what they are. And to me, it's super fun to kind of dive in there and see what's going on, because I've seen the impact that understanding that process has, and I think that's a great idea. All right. All right, everybody. Well, good hanging out. I will let you get back to your Thursday evening. I think my wife and kids and we have tickets to go see Superman tonight. See how that is. I've always liked the franchise, and I was a huge fan of Guardians of the Galaxy. So I want to see how Mr. Gunn does with the franchise. And you guys have a great evening. For those of you that are in the Momo class, the momentum class, I will see you again tomorrow morning for our last day 4 of trading momentum. And then we'll see what the week can bring us. All right. All right. You guys have a fantastic evening, and see you manana.